As well to this video, 6 a.m. UK time here, pro multi-asset day trader Will Sebastian. We're going to be going over all markets on Zoom again until they go underneath if you want to learn to trade for income. So by the title of this video, you might have seen it entails a 20 and 200 moving averages. Now, the reason why I've done that is because personally for me, I use the 20, the 40, the 100 and the 200 MA. People ask me here and there why I use those. Of course, I explain that every day, more or less, to my members. But in basic terms, I will just cover it now. So the 20 and the 40 moving average are your nearest moving averages. Okay, so in other words, those are the ones that I use to track near-term price movements. So if I change my pound New Zealand to something that makes that more relevant, you can see that this chart specifically, okay, we're on the daily now, you've got your 40 MA there and your 20 MA there. So it's telling me, in other words, the near-term average. And that's really handy because the near-term average is showing you more or less which way you're going or what the value of your trade is near-term. So if you were, let's say, therefore away from your moving averages like this. So you've got your 20 and your 40. If you look at the chart on the weekly, you can see we've moved slightly away from the nearest moving average. So on average, in the near term, okay, we're above average, right? And like I said, that's handy for identifying near-term trends and knowing when you're starting to slide away from the buy areas, essentially, to sell areas. It's all about gauging value over time because value in the market is what you need to make money. So, for example, if I wanted to short, I might tell myself that at this point, because there's key price action here, we're further off these moving averages, that I want to sell. Okay, and it's like your stock oscillator will come up, and you'll be in a position where, because you're further away from the average, it's not a good time to buy because you're basically buying a higher price, and it's less likely you'll make money. Of course, if we drop nearer the moving averages, it would be different, and this would become more of a long. Okay, because again, you're coming back to an average price. So the averages are telling you where price should be at any given moment. And tracking that is going to be useful on the nearer term and the longer term. Obviously, in the same instance here, the further away you are from these higher moving averages shows you how high price is on the longer term. Okay, and therefore you would be again more inclined to short on the long term. So at this point, I know on the if I'm looking for a long-term move, it's likely to be short because I'm far away from my higher moving averages. Okay, my 100, my 200. So those high moving averages are tracking the long-term trend for me, and the 20 and the 40 are tracking the near-term trend or where the price is near term. And we use this as a really good mechanism because coming back to the moving averages, as we call it, it basically gives you a mean price or an average price, which you're looking for at all times to sustain yourself on good market deals. Now, this exists everywhere. I mean, you could even put a 500 MA on if you want. But if you just look this chart, okay, I've got the 100 MA down here, which we're now touching. Okay, but the 200 MA is up there. So you get times where you can then infer from that the difference. The long term trend is up there, and the longish term, if you like, is there. So what you would need to do in that instance is probably drop your time frames down to something like your daily. And now what can you see? Well, you're coming back to the averages. So again, these are going to be areas where I can use my brain to identify how short something should be. Okay. And of course, in this instance, you're almost at your earliest MA. Okay. You're 20. And again, that coincides with key price action, so it constitutes a short. The secret sauce to all this, obviously, is our method with our risk management strategy. You can't have any MA trading or moving average trading unless you understand risk management fully, because this price is more valid than that price for shorts, and that price is more valid than this one. And as you go up through the scale, you will start to notice that you have more and more value, or you have larger swing moves when you're reflecting from higher long-term moving averages. Okay, so really key to understand that moving averages are there to tell you how valid price is. Okay, so for shorts, it wasn't very valid here because you were so far off your nearest MA. But now you're back to your MA, you might consider short because you're getting back to what is a high price within the last 20 periods. Okay, not within the 100 or the 200 or the 500. Okay, so it wouldn't be a good short swing because it's only at the 20 MA. If it was at the 1000 MA, it'd be an investor long term trade. Um, so that's how you use them, or how I use them at least. They're just value gauges on all settings for all kind of time frames. Obviously, the nearer term being the lower end of those moving averages, and the higher term, swing trades, investor trades, being at the higher moving averages. And like I said, if you want to play around a bit, you could have your 500. Some like to use what we call the bankers a moving average, which is the 55. So there's all sort of angles with it, but in plain view, I'm using them to track what is value and what is not. Okay, so like I said, that wasn't a short because the MA is up here. Now we're back to it, I might consider a short. It's nothing to do with the MA being like a whip and hitting the price away, deflecting it like a lightsaber. It's all to do with the value of price, because other traders and investors will be feeding in at that point saying, okay, well, yes, I would like to short as well because we are back to average. So I hope that helps. Don't forget, we teach every day live on Zoom. Be doing it again today. I'll see you there if you're on board. See you soon.